Hi, Business 202. This pre-recorded Google Hangout gives context to Chapter 23, Performance Evaluation and Variance Analysis. Anytime you're dealing with manufacturing, it always is a good idea to have a picture in your mind of the factory that you're trying to work with. And the Cameo chapter company is the BMW Group Mini Cooper. And if you go to your notes and click on the little BMW image here, you will get a 10-minute tour of the BMW plant. And as you review this, think about what the cost drivers would be for the various activities that go on in the plant and how these cost drivers would be counted, who would count them, and how often they would be counted so that they could be reported to management so that they could make decisions based on the information that these cost drivers would produce. Okay, so what are we doing in this particular chapter? We are shifting gears a little bit from what we had done in the previous chapter. What we're doing right now is working at the end of the period rather than, as we had before, at the beginning of the period. So let's just take a look at where we've been and what we're going to do now. Imagine this as a picture of a year. BOP represents the beginning of the period where the business concentrates on planning for the year's upcoming operations. And on the right-hand side of the timeline, the EOP, end of the period, is when the management takes a look in the rearview mirror and decides if the company has performed according to plan or did it deviate from plans and why. What are some of the activities at the beginning of the period? Establishing product pricing, whether it's a cost plus or whether it's a competitive type of pricing structure. Cost volume profit analysis to determine the risk of being at break even or below. The determination of what cost drivers to use to monitor the variation, and the planning budgets that happened at the beginning of the period that we just finished in Chapter 22. At the end of the period, the company does take a look in its rear view mirror and tries to determine, well, if the company made units that were in a is trying to do is to control the costs for the units that it actually did make. In order to do that, there is a new concept that's introduced, the standard costs, what it should cost, both price-wise and quantity-wise, to make the units that it had intended to use. And then the third concept at the end of the variance analysis. This variance represents how much the business costs from the flexible or control budget. Also, in giving context, does spend much of its time dealing with financial costs. Financial costs don't give you the entire picture. In coordination with generating all the financial cost variances that your chapter describes, there are other very closely looked at key performance indicator, KPIs, that are non-financial in measure. And in assessing the ability of the company to meet these non-financial measures, along with cost information, can give management better context about how well the business is running. As an umbrella over all of these operations would be a framework on how to determine what the non-financial key performance measures are. At the beginning of the period, the company would have to give and create what those measures are, give the workers a great example of what they should be doing. where this source of the information comes to keep track of the volume of these items about the non-financial key performance measure in greater detail. And I suggest that you do that before you get into the details of the financial numbers, which comes next. The major thrust of what your chapter does is to give you the backdrop behind the financial calculations for cost variances. And it begins on page 1065 with Exhibit 1. And here is that exhibit right here. And this particular exhibit outlines the standards that the company will use during the year to determine what the price of its product is. In this case, the company is like a Wrangler jeans, and they're making extra large pairs of jeans. And they have decided that the materials, the blue denim, would be $5 per square yard. The direct labor would be an hour, and factory overhead would be applied to work in process based on the number of direct labor hours at $6 an hour. The quantity of denim material would be 1.5 yards per pair of jeans. The worker's time should accumulate 0.8 of an hour per pair of jeans. And finally, since the cost driver is direct labor hours, as it is in all the cases in this chapter, 0.8 of an hour of overhead would be applied to each pair of jeans also. If we would take the standard price of what is being consumed times the standard quantity of what is consumed for each unit, we would get what's known as the standard cost. So $5 a yard times 1.5 yards of materials would give $7.50 as the cost of direct materials for each pair of extra large jeans. For direct labor, $9 labor rate times 0.1 of an hour would give $7.20 as the amount of labor attached to each pair of jeans. And finally, for overhead, $6 per overhead hour determined using a predetermined rate times 0.8 of an hour gives $4.80 as the overhead allocated to each pair of jeans. Adding up the materials cost, the labor cost, and the overhead cost, the estimated manufacturing cost at standard costs for an extra large pair of jeans for this company is $19.50. Okay, now during the period, once we have established these jeans, the company has produced an actual quantity of 5,000 jeans during the month of June. At the beginning of June, let's say June 1, the company may have had some other idea of what the production would be. It could be more than 5,000 jeans. It could be a lesser volume than 5,000 jeans. But for whatever reason, this particular company made 5,000 jeans for the month of June. So the control budget or the flexible budget should be based on the 5,000 pairs of jeans that it actually made, so that when the flexible budget is compared to actual cost, useful management information will result. So let's just do that. Let's create a flexible budget for the product that actually was made, the 5,000 jeans. In the first column, actual costs were for June. In June, the Western Rider Company incurred $40,150 of materials cost, $38,500 of labor costs, and $22,400. Adding all of the actual costs together, the company incurred a total manufacturing cost of $101,050. Now, if the company made 5,000 jeans, what should it have cost the company? Well, in this case, to use this, so to figure the cost, that each jean cost $7.50. If the company produced 5,000 jeans, 5,000 times the standard materials cost would give you $37,500 as the standard cost of what it should have taken to make funds, which you can see is lab cost of $40,150. So the difference between the actual incurred and the standard that it should have taken resulted in a cost overrun or an unfavorable cost. The difference between these two, $2,650. Now, it just so happens by convention, positive numbers would in the variance accounts and negative numbers and credits in the variance accounts. For labor, the company actually incurred $38,000 if it made 5,000 jeans, and the labor cost per jean, $720 times 5,000, will $36,000 as the standard. Again, the company is over its budget to make 5,000 jeans, and so we would record a $2,500 unfavorable variance for labor as well. For the overhead, the standard cost was $480 times the 5,000 jeans. That is going to produce a standard cost of $24,000. In this case, the standard cost is larger than the cost that actually was incurred. So this is a good deal. The company is under budget, and this amount will be reported as a favorable variance for factory overhead. Adding the three variances together results in a manufacturing cost variance of $3,550 net unfavorable. Okay, that's variance in a nutshell. At the beginning of the period, the company determines what its standard costs are and makes a planning budget based on the number that the company thinks it's going to produce during the period. Once the planning budget has been constructed, which is used to determine the materials, the labor, other resources, including financing that's used during the year, at the end of the period, the company makes a flexible or control budget to compare against the actual number of units that were produced during the last production cycle. It may or may not be the same number that was planned at the beginning of the year. Okay, now, having established that the total manufacturing for the 5,000 jeans was $3,550 over budget, it's up to management to determine why that was the case. Anytime a manufacturing operation happens, two elements contribute to costs being favorable or unfavorable. The first element deals with the price that's paid for the resources that are consumed. The company may have bought resources at a premium and had cost overruns because of price, or the company might have gotten substantial price discounts for quantity buying and got the good quality product at a price less than they had originally bargained for. Additionally, the company could have used a quantity per unit manufactured that differs than what was planned. So what the accounting record should show is the number of dollars, let's say for direct materials, that were unfavorable because the company paid too much for what it used, the price variance, or how much of the $2,650 material unfavorable variance came about because too much, in this case, blue denim fabric was used to make the 5,000 jeans. Same thing with direct labor. Did we use the right personnel for the jobs at hand? Did we pay the people the right amount? Did we assign the right people to do the task to make the jeans? And did those folks that were assigned to the production task units that we had planned? And the same thing goes with factory overhead. The controllable variance represents the amount that a production manager can control, and it represents overhead plus the fixed manufacturing overhead. Manufacturing overhead, though, has another element that big picture because of the way fixed costs are handled, and that is something called a volume variance. You'll recall in a previous about the establishment of predetermined rates. That's done at the beginning of the period when the actual production quantity is unknown. If the actual production quantity differs from the planning amount, the PDR, or predetermined rate, will misstate the amount of fixed overhead costs that the units made during the production cycle actually consumed. So there is an error that's created by using the PDR. What the fixed overhead volume variance is to measure the amount created by manufacturing a number of finished goods that differed from the planned number of finished goods. Okay, video, we will focus on the material price and quantity variance and the direct labor rate and time variance. In a separate video, we will focus on the variable factory overhead. Although the calculations of variable factory overhead, materials, and labor variances, the interpretation differs, and so it does warrant separate treatment. Okay, so let's just look at how we could dissect some of the unfavorable 2,650 materials price variance that comes about. And this is using the schematic that the text does inside the chapters. So to summarize the scenario, the company actually made jeans. It actually consumed 7,300 yards of denim in making those of jeans, and $1.50 are the jeans that it manufactured. So if you would plug 7,300 yards times $5.50 cost per yard, you will arrive at the actual costs of $40,150. This $40,150 would represent the debit or increase that would go to work in process inventory. Okay, so how do you isolate price and quantity? Well, price and quantity, we would want to compare the actual costs incurred, which would be actual cost times actual quantity. 300 yards were used, so that's 40,150. And let's price those 7,300 yards at the standard price, which from the previous table, you'll recall, is $5. 7,300 yards times $5 a square yard gives $36,500 as the amount that the company should have paid for the 7,300 yards that it did use. So the difference between the actual cost incurred and the amount that it should have paid for the 7,300 yards that it used, 36,500, would give an unfavorable price variance of 3,650, meaning that the company, because of iterations, paid $3,650 too much. But wait a minute, the actual variance was only $2,650. Why, why did that come about? Well, it's because of quantity. So how would we isolate the quantity variance? Well, we start at this middle point, which tells us how much we should have paid for the yards that we actually did use. But let's compare this middle value, the number of should have used to produce the quantity of finished goods that we did. And according to our standard, each of the 5,000 times 1.5 yards means the company 7,500 to make the 5,000 finished pants. 7,500 times 5, 37,500 standard cost. So in this case, the company used fewer yards, 7,300, compared to the standard of 70. The company will have a favorable variance of 100 fewer yards, 7,500 less 7,300, times the price that it should have paid for the yards that it used, $5. So 200 times 5 will produce a $1,000 favorable variance because the company used less raw material than standard. Combining the unfavorable pricing variance for raw material with the favorable use variance for raw material reconciles to the flexible budget difference from the actual costs incurred, which is $2,650. Okay, so that's the material variance. Now, you may be wondering what the heck this little character is here. It's a phonic device to remember some oversized bottom. And this particular Cupid doll had on a, and that's the mnemonic that you folks should use in remembering how to isolate price and quantity variances. Just like this little Cupid doll that has its folks in coming up with the actual quantity compared to actual price and actual quantity compared to standard price and standard quantity compared to standard price should put your and calculate the actual cost incurred, what it for the units that you actually made, Isn't that a terrible example? Okay, so that takes care of the material price, material quantity. Let's turn our attention to labor, what your book calls rate. It's a price. It's a price you pay people per hour. And time, well, that's worked. Calculations were the same. Again, big as on a sheet so that you can cost incurred, what it should have cost you for the hours that were actually worked, and what it should have cost for the hours that you should have used. So from Exhibit 1, we know that the company actually worked 3,850 hours at an actual rate of $10, and that produced an actual cost, the charge of $38,500. Should it have cost the company to work 3,850 hours? Well, the standard cost per hour was $9. So for some reason, the company paid $1 more per hour than it wanted. This could be either due to having to reassign more skilled labor than necessary. It could be because of a union contract that gave folks an increase in salary. For whatever reason, it cost this company $1 more per hour. So the cost that it should have spent would be the 3,850 hours that it worked times a standard rate per hour of $9, or $34,650. As you can see, what it should have cost, $34,650, is below what it actually did cost, $38,50. So the difference, $3,850, would represent, looking to the number of hours that were actually worked, and an unavoidable or cost overrun variance. At the standard cost of $9 an hour, see that the higher skilled labor was actually able to make the jeans a little bit quicker. They're better skilled. So the difference between what it should have taken and what they did take, 150 favorable hours, times the standard cost of $9 an hour, the business produced a $1,350 by assigning task. And when we combine the fewer hours with the higher rate that the highly skilled workers were paid, we with a $2,500 unfavorable variance. What's the conclusion? Well, even though we had higher skilled individuals and they did save some time, the amount that we had to pay them in additional wages did not offset the efficiencies that they brought about by working fewer hours. So this particular business decision to assign higher skilled workers that get more pay to reduce the number of hours just was not a good decision, because we still incurred an unfavorable variance for direct labor. To summarize the variances, the actual cost for the actual quantity used compared to the actual quantity used times a standard rate will give you a price, the difference between what it should have cost you for the volume that you actually used compared to the standard volume at the standard rate, isolates a quantity variance. And the mnemonic, again, just like the little Cupid doll that has its bottom on the sheet, you folks want to put your big as on a sheet so that you can calculate these three elements of variance analysis. That's it. Give the end of the chapter exercises a try, and as always, please do not hesitate to contact me with any questions